Welcome to the Oregon Pacific Financial Advisors 2020 Halftime Report. Thank you so much for taking the time to join us to learn a little bit about what transpired in the first half of this year, as well as what our expectations are heading into the second half of what has turned out to be one of the most volatile years of recent memory. We appreciate your time, and we hope that you find this as valuable as we did. One of our goals today is to discuss some of the factors that influence market performance during the first half of 2020, then review the underlying fundamentals. It would be impossible to cover everything that's happened so far, but we believe that focusing on some key developments may help give a clearer picture of the markets. Today, we will review where we've been, some key economic fundamentals, and what may lie ahead in the second half. This broad view is designed to help you stay informed and give you a better understanding of some of the perspectives guiding our investment process. Let's begin by reviewing how the stock market performed during the first half of 2020. Here is a snapshot of the S&P 500 index performance for the first 6 months of 2020. The S&P 500 index tracks the market capitalization of 500 large domestic stocks. The index is often viewed as a common benchmark for analyzing the performance of the U.S. economy. The S&P ended 2019 at 3,231. At the end of June 2020, the S&P closed near 3075. Let's look at some key events that affected stock performance in the first half. As we review these milestones, keep in mind that it was an extremely volatile period, which reminds us all that the return and principal value of stock prices will fluctuate as market conditions change. As the new year began, stocks marched higher in January and February, lifted by the completion of a Phase 1 trade deal between the U.S. and China, a monetary policy engineered to stimulate economic activity and growth. As we all know, the market narrative changed quickly as the COVID-19 outbreak spread throughout China. As it grew, the Chinese economy was devastated, and other countries began to report cases of their own. U.S. markets remained unfazed until February, when health officials announced that what was quickly becoming a pandemic would likely have a widespread impact domestically. In March, stocks swung wildly on news of economic contraction. The rise in domestic infections, general uncertainty regarding how far the economy might fall, and how long the pandemic might last. The stock market moved higher in April as investors evaluated corporate earnings and some troubling economic data. And gains accelerated after April 21st on news of positive results from a clinical trial investigating a treatment for COVID-19. Stocks notched another solid gain on May 18th, when the Federal Reserve restated its commitment to do whatever would be necessary to support an economic recovery. On May 26th, the day following Memorial Day weekend, stocks surged due to rising optimism over economic reopening, reported declines in new COVID-19 cases, and further news surrounding the development of a potential vaccine. In early June, however, the optimism, which had driven stock prices higher those past several weeks, slipped away. On June 10th, the Dow dropped 1,800 points on reports of a jump in COVID-19 cases, which sparked worries of a second wave slowing the economic recovery. So we've talked a bit about how the S&P 500 performed during the year's first half. But how does that performance compare to expectations? Well, let's explore this. At the end of each year, various media outlets compile many Wall Street analyst predictions for the year ahead. This slide shows the variety of projections shared at the end of 2019. How do those projections compare to reality so far? As we mentioned on the previous slide, the S&P 500 finished the first half of the year at nearly 3,075 points. It may be unfair to compare actual mid-year results to a prediction made before COVID-19. But it's worth a moment to see where stocks are in relation to market expectations. Predicting where the S&P 500 will be by the end of the year has become even more difficult since it's challenging to estimate corporate earnings. This is especially true now since no one has a clear idea of when American spending and business investment may return to normal. Nevertheless, we'll discuss a little later in the presentation what Wall Street analysts may be looking for during the second half of 2020. Now, let's look at the economic and financial indicators to help understand how we got here. To put today's economy in perspective, let's look back to January 2010, when we were emerging from an economic slowdown. Here, you see 20 speedometers representing 20 different economic indicators. From corporate profits to energy costs, 17 of the 20 indicators were green, which suggested the economy had a solid foundation. None of the indicators were red. Let's fast forward to January 2020. 10 of 20 indicators reported positive or strengthening numbers, but you can see that an equal number of indicators had a neutral or negative rating. In particular, the political environment and geopolitical risks were in the red. In June, the speedometers suggested a more cautious outlook. 4 were green, 9 were yellow, and 7 were red. The widespread influence of COVID-19 is reflected in many of these indicators. We've seen some states open certain businesses, then adjust the situation due to outbreaks. Some states may continue to give mixed signals until we move closer to a potential vaccine. By now, almost every American has been affected in some way by the turmoil brought on by COVID-19. It's fair to say that the pandemic produced unprecedented economic disruption and upended the capital markets in a way that we haven't seen since the credit troubles of 2008. In the next slides, we'll examine how the pandemic played out on the key drivers of stock market performance. Let's spend a few minutes on the Federal Reserve and how its monetary policy responded to combat the disruptions resulting from COVID-19 and the subsequent lockdown of the U.S. economy. Stemming from the lessons learned during the 2008 credit crisis, the Fed acted much more quickly and decisively to address the strains in the capital markets that were already beginning to emerge. Beginning with the surprise Sunday evening press conference on March 15th, Fed Chair Jerome Powell announced a drastic reduction to the federal funds rate to zero, as well as committing up to $700 billion in assets purchases to maintain liquidity in the credit market. Initially, the market greeted this move negatively, believing that the Fed saw more trouble than the market had factored into stock prices up to that point. As the timeline illustrates, the Fed continued to implement new measures to steady the financial markets. While the Fed implemented more programs than we have outlined, let's take a look at some of the key policy initiatives put in place during the worst of the market slide, including the following. The creation of a commercial paper funding facility to buy short-term unsecured debt was crucial to ongoing business funding. The creation of a money market mutual fund liquidity facility to promote the purchase of assets from money market funds, ensuring value preservation. Establishing funding to support credit to large companies, including reviving the 2008 Term Asset-Backed Securities Loan Facility, or TALF, program to prop up corporate bonds. With the passage of the Paycheck Protection Program, or PPP, and the extensive distress in small businesses nationwide, the Fed introduced a lending facility to buy PPP loans. This helped to facilitate bank participation by taking non-performing loans off of banks' balance sheets. The Fed also introduced sweeping changes to the Main Street lending program in order to make it possible for a wider range of small and medium sized businesses to apply. Now, what does all of it mean? Remember back on the image that showed the stock market performance in the first half of the year? On May 18th, stock notched another solid gain when the Federal Reserve restated its commitment to do whatever would be necessary to support an economic recovery. This chart shows the relationship between changes in S&P 500 performance and the 12-month forward earnings, or EPS. As you can see, the two lines have generally moved in the same direction over the past decade. But what has happened in the last few months? The volatility in stock prices and earnings is the result of COVID-19. Now, here are a couple reminders. First of all, past performance does not guarantee future results. Over the next 10 years, the correlation between stock prices and corporate profits may look different. Secondly, individuals cannot invest directly in an index. And thirdly, the return and principal value of stock prices will fluctuate as market conditions change. Shares, when sold, may be worth more or less than their original cost. At the highest level, the Federal Reserve has three functions: to provide an effective payment system for the U.S. to regulate banking operations and to conduct monetary policy. When conducting monetary policy, the Fed is tasked with supporting maximum employment, stable prices, and moderate long-term interest rates. As it works to uphold its monetary policy goal, one of the indicators the Fed monitors is the overall level of consumer prices, which helps to determine whether to adjust interest rates. The Fed has stated that it's comfortable with inflation in the 2% range. This line graph shows the core consumer price index, or core CPI, over the past 50 years. The core CPI tracks what urban consumers pay for a specific group of goods. Now, this measurement does not include energy or food because those prices are often volatile. Some economists use this measure to track inflation. As you can see in this chart, the pandemic's influence on inflation trends has been dramatic in recent months. For example, when most states were urging residents to stay at home in May 2020, energy CPI dropped 18.9%. Let's take a moment to talk about wages and unemployment. This graph shows the unemployment rate in year-over-year wage growth for the past 50 years. Do you notice anything about how these two lines relate to one another? Now, most of the time, wages and unemployment have an inverse relationship. When one goes up, the other goes down. But my goodness, who could have ever expected the change in recent months due to COVID-19? As you can see in the chart, unemployment jumped to 14.7% in April 2020, but in May it fell to 13.3%, which surprised some Wall Street analysts. Where will it go in the rest of 2020? Many of Wall Street's smartest minds are trying to figure that out right now. And you can expect the unemployment rate will be aligned with their outlook on COVID-19. The University of Michigan Consumer Sentiment Index is one of the most widely used sources to help analysts understand how the average consumer feels about the economy. This index is extremely valuable as it surveys at least 500 residents of the continental U.S. each month by phone. The survey uncovers consumers' opinions regarding their finances, as well as business conditions in the country. Understanding how people feel about the economy is essential because consumer spending accounts for more than 2/3 of the gross domestic product. The chart shows a long-term upward trend in consumer sentiment But like many other indicators we will see today, COVID-19 has changed that outlook. While most consumers believe that economic conditions could hardly worsen from the recent shutdown of the national economy, prospective growth in the economy is more closely tied to progress against the coronavirus. This was reported in the University of Michigan report in June 2020. The early opening of the economy has undoubtedly restored jobs and incomes, but it has come at the probable cost of an uptick in the spread of the virus. This chart shows the long-term trend in existing home sales, but I wanted to draw your attention over to the far right side. You may have to squint a bit, but that last figure is 3.9 million, a dramatic drop from just a few months earlier. But here's a pop quiz. Are existing home sales a leading economic indicator or a lagging one? Before you answer, a quick refresher on leading and lagging indicators. Leading economic indicators are statistics that tend to precede overall economic trends. Building permits, for example, tend to be a leading indicator of new home construction. Lagging indicators are statistics that tend to follow a particular economic trend. So, returning to our questions, are existing home sales a leading or lagging indicator? Of course, existing home sales are a lagging indicator because they tend to be influenced by changes in mortgage rates. The household debt service ratio shows a critical trend. It gives us some perspective on how much revolving debt, in other words, credit cards, that households manage. As you can see, revolving debt hit a high in the fourth quarter of 2017 and has never approached that number again. Does it mean that Americans are using debt more wisely? Now that's uncertain, but the overall downward trend means debt payment as a percentage of disposable income is remaining below 10%. Before we move on to our outlook for the second half of 2020, let's take a moment to consider the variables that could upend such forecasts. The market's remarkable resilience in the first half of 2020 can be attributed to unprecedented monetary and fiscal support, as well as optimism regarding a potential COVID-19 vaccine. While the Fed has promised to continue supporting economic recovery efforts, it remains less than certain that the government can maintain its pace of spending or that medical professionals will discover a vaccine in advance of a new flu season. In addition to the upcoming presidential election, other potential headwinds could cause stocks to retreat. The potential for a new wave of COVID-19 cases and a slower than expected economic rebound, as well as the potential for heightened geopolitical tensions, could all have an impact. We also cannot discount the possibility that just like we saw with the emergence of COVID-19, that there is always a possibility that what trips the markets up will be something that no one could anticipate. Of course, no one can predict what will happen in the future, but we hope the following perspectives help you understand what we believe may be on the horizon. Now, let's dive into forecasts for the second half of the year. Some market strategists employ what's called a bottom-up target price to set their price target for the S&P 500 index. When setting a bottom-up target price, market strategists focus their attention on estimating earnings for all of the S&P 500 companies. By contrast, a top-down investing target price places a greater emphasis on macroeconomic factors when making an investment forecast. The chart shows the expected price target of the S&P 500 and compares it to the actual closing price of the index. But a word of caution on this type of analysis. Just because the closing price is below the bottom-up target price, it may not mean the market is undervalued. The bottom-up price target is a theoretical target. It may or may not be reached. And as you can see in the chart, the bottom-up price target has been above the closing price for some time. Here are a few things to keep in mind. First, past performance does not guarantee future results. Second, individuals cannot invest directly in any index. Third, the return and principal value of stock prices will fluctuate as market conditions change, and shares, when sold, may be worth more or less than the original cost. Much like the previous charts, COVID-19 is having a rather dramatic effect. In this one, real gross domestic product, or GDP, is expected to drop anywhere between 4 and 10% this year. The Federal Reserve's chart also shows a dramatic rebound in 2021 and 2022. And as you can see, longer term, the Federal Reserve sees the GDP settling in the 2% range. As a wise market strategist once said, stock prices are based on earnings and what price people are willing to pay for those earnings. This chart shows the trend in corporate profits in the United States since July 2017. As you can see, profits dropped 12.4% to $1.672 billion in the first quarter of 2020. It was the sharpest decline in corporate profits since the last quarter of 2008. You also may have heard the expression that the stock market operates as a discounting mechanism, quickly processing all available information and potential future events. Clearly, the stock market isn't dwelling on the near-term drop in earnings, but instead appears to be focused on the earnings potential of 2021 and beyond. As we discussed earlier, the Fed is watching the economy as it assesses whether to further adjust monetary policy. With the Fed funds rate at 0%, any reduction in rates may be unlikely, especially since Fed Chair Jerome Powell has previously said that he is not inclined to move into negative rates. So, what could be ahead? The Federal Reserve Open Market Committee is scheduled to meet 4 more times in 2020. Typically, if the Fed is going to make an adjustment to interest rates, they will announce the change following their 2-day meetings. Now, here's another relationship to understand. Bond prices and bond yields have an inverse relationship. In other words, when bonds go up, bond yields go down. After experiencing years of low interest rates, many investors may be surprised to realize their bonds can lose money if sold before reaching maturity. Bond fund values may decline during periods of rising interest rates, but a changing tide in the economy doesn't mean you have to abandon all fixed income. Often, this movement is an important part of a well-balanced, diversified portfolio that may provide investors the income that they need. Keep in mind, however, that there is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Tuning out headline noise while managing your finances is not always easy. However, wise investing involves more than reacting to headlines that may discuss consumer sentiment or geopolitical developments. For investing opportunities, one approach is to stay focused on fundamentals, like a company's earnings or economic data. We've gone over a lot today, and if you remember just one detail from our presentation, I hope it is this. Emotions have no place in investing. Market corrections are a normal part of market cycles. We saw a vivid and compressed illustration of this from March through May of this year. This chart shows the intra-year lows each year, going back to 1980, in red, with the annual returns in blue. In 2019, we experienced a 7% intra-year drop coupled with a 29% gain. So far this year, the markets are on a different trajectory, reaching historical highs in February, plummeting in March due to COVID-19 and economic shutdowns, and demonstrating a strong rebound in April and May. Volatility can be uncomfortable, but it is normal. Managing your emotions during good times is just as important. Ultimately, taking a long term view of the markets is essential when you're trying to pursue your long term goals. If you ever feel concerned or want to understand what's happening, lean on us for support. We're here for you, and we want to help you make the most of your financial life. This slide shows why it's important to ignore headlines and focus on your time horizon, risk tolerance, and goals. If we look at the beginning of 2000 to the end of 2019, we can see the danger of missing some of those powerful daily jumps. As this chart illustrates, a $10,000 investment on January 3rd, 2000 would have more than tripled in value to over $32,000 by the end of 2019. Had an investor been out of the market and missed just 10 of the best days during this period, that investment would be worth only half as much. If an investor missed just 20 of the best days during this period, they would have essentially gained nothing. Miss 30 or more of the best days, an investor would have lost money. Investors who sell stocks in response to difficult market conditions often miss these all important best days because they often occur when everything seems so negative. As we wrap up here today, we just want to thank you again for taking the time to joining us for the Oregon Pacific Financial Advisors 2020 Halftime Report. If you have any questions at all about any of the information we covered or specifics about your own situation, feel free to reach out to us by email or telephone or visit our website at opfa.com. Securities offered through United Planners, advisory services offered through Oregon Pacific Financial Advisors.